Are you struggling to figure out if retail is the right investment? Industrial, office, storage, hotels, multifamily. There's all different kinds of commercial real estate asset classes, but which one is the right fit for you? Well, the truth is, choosing the wrong commercial real estate asset class can lead to burnout, it can lead to bad deals, it can lead to wasted time, or worse, losing money on your investments. But we're gonna make sure that doesn't happen. In this video, I'm gonna show you how to pick the right commercial real estate asset class that actually aligns with your investment goals, with your skills, and with the lifestyle that you're looking to build. Let's dive in. Welcome back, wise investors. What if I told you that picking the wrong commercial real estate asset could cost you thousands? It could tank your dreams of passive income altogether. Well, today we're gonna make sure that that doesn't happen to you. We're gonna dive into the different commercial real estate asset classes. Think time management, think cash on cash returns, think of understanding what your investor identity is and which asset class and what strategy best aligns with you achieving those goals. Because by the end of this video, you're gonna know exactly which assets fit your goals, whether you want passive income, whether you want high yields, high returns. We're going to cover it all. Now, don't forget, if you get any value from this video, be sure to hit that like button, drop a comment down below, and don't forget to subscribe to the channel if you are ready to level up your commercial real estate game. All right, so let's go ahead and dive in to this little presentation that I went ahead and created for you. And this is to cover understanding all of the different commercial real estate asset classes. Now, understanding first and foremost, the number one mistake that most newbies make is they decide to chase returns without actually understanding the asset class, the nuances of the asset class, the management, the strategy that goes into actually materializing the cash flow and the returns that you're looking for. And you don't want to be the person that just chases an investment strategy or a trend because you see other people doing that. Not all investors are created equal. And depending on what your goals are and when you're trying to achieve those goals, the investment trend or strategy that's working for most people may not actually align or work for you. And the last thing you want to do is go out and buy a deal thinking that it's a great investment because you see everybody else doing it. And then ultimately you get stuck in a deal, your capital, your time, your resources, and you're literally wishing you never bought that investment property because it's not aligned with what you're actually trying to accomplish. You don't want to get stuck managing deals that don't fit your life. And so understanding that you need to pick an asset based on alignment and congruency with your goals versus one that is actually just popular and you see working for everybody else, something that you want to make sure you avoid. So let's talk about setting the stage here for this quick video. Number one, right, choosing the right commercial real estate asset isn't just about returns. It's actually about aligning your goals, aligning the skills that you have right now to bring to the table and the lifestyle that you're actually trying to accomplish. And we talk about this in previous videos, right? Understanding based on your time, your capital, your resources, your skills, and what you're trying to accomplish. That ultimately is going to align with a certain investor profile, which is going to align with a certain type of asset class or investment strategy. And so we really want to understand what we're trying to do for us selfishly in the beginning to then understand how each asset type operates, the management needs and intensities, the return profiles that are tied to those commercial real estate assets, and of course, making sure that these things are aligned with your investor identity. So the four key factors that I want you to consider when you're thinking about, what type of asset should I be thinking about investing in is these four things. Number one is the management intensity. How active are you planning to be in your commercial real estate business? Do you want to be super hands-on? Do you want to self-manage? Do you want to buy an asset that has one tenant with a really strong lease that puts all the responsibilities back on the tenant and you're way more hands-off? Or do you want to own a hotel that is extremely management intensive and is a living, breathing, operating business that requires you to be extremely hands-on? Do you want to work with a third-party property manager, or do you want to be the one managing all of these properties yourself? Something to think about management intensity is something that is really important because this is going to tie in with how much time and energy you want to put in to managing the asset to get the returns that you're hoping to get. The next thing I want you to think about is the asset stability. So thinking about what kind of tenants do you want to deal with? Are those mom and pop type of tenants? Do you want to deal with national brands like Starbucks and TJ Maxx, right? Because each of those tenant profiles is going to have pros and cons. So understanding that the types of tenants and the type of asset and in which market you find it in is going to determine the stability and or the risks that come with that particular investment asset type and the strategy that goes along with it. The next thing I want you to think about is the cash on cash return expectations. What are your return goals? Do you want to be hitting a 10% cash on cash return, a 12, a 15? Maybe you're okay with just getting a 6% cash on cash return. Understanding your capital goals based on what kind of money you're going to put into the deal and what you expect to get out of it or what your investors are going to expect to get out of it will help you determine and narrow in on what asset actually aligns with achieving those goals. And the next we have your investor identity, right? Are you somebody that's doesn't have a ton of time, but you got a lot of money and you maybe just want to be more of a passive investor or find an asset that is very minimal intensive management? Or do you have tons of time and this is a full-time focus and you want to create value and equity through a bunch of time and energy that you're willing to put into the deal and obsess about it and eat, sleep, and breathe it, right? More hands-on. There's lots of different investor identities, and based on what your identity is, will help you better understand which asset type will most align with that identity. Now, this is just a very quick, high-level CRE asset class matrix, which you can pause it here and just kind of go through these and just know that there's nuances to every single one of these categories of some things that maybe fall a little bit further or a little bit behind what we would call management intensity, right? Some may have a little bit more management intensity. Some may have a little bit less than what's put here. But overall, you can see that, a triple net Starbucks that just has one tenant and all of the lease responsibilities for management of the property fall back on the tenant because of this type of lease structure, the management intensity of this type of asset is extremely low, right? But while it's very passive, it doesn't have big cash on cash returns because it's stable and it's safe and it's long term, and therefore the returns are going to reflect that. Now, if you're somebody that's looking to do development, or maybe you're taking on hotels or value add mobile home parks or value add multifamily, right? These are more active management requirements, but you're also going to get higher returns potentially as a result of that. So again, understanding the nuances with each asset class, with each asset strategy and type, this will help you understand which ones may be a little bit more aligned with what you're looking to hit and which ones you may want to steer clear of. Next, let's talk about retail properties to get a little bit more granular on what some of these asset types are. Now, we talk about kind of the main asset types in commercial real estate being multifamily, retail, industrial, and office. Now, there are subcategories underneath those, as well as other investment categories in commercial real estate. But those are kind of the main four, we'll call them stools to the chair, or legs to the chair, right? So retail properties, you've got strip centers, you've got shopping centers, you've got the big power centers, right? The Home Depots, the Walmarts. And then sometimes you even have the single tenant, triple net, standalone type of properties. Maybe that's, your quick service restaurants like the fast food, or maybe you got a Starbucks drive-through, right? Those can also be considered retail as well. Management-wise, they're generally moderate, if not high. However, depending on the types of tenants that you get in there, the length of the leases, and the responsibilities that you can pass off from you as the landlord back onto the tenant, you can make these moderate, if not low, management intensity. Now, the returns are generally going to be anywhere from a 6, we'll call it, to a 9 or a 10%. But if you are doing value add, right, you can really find ways to force cash flow and equity growth by securing new tenants into properties that maybe have vacancies. But overall, retail properties are great for value-add investors and those who are really good at understanding how to negotiate, secure, and stabilize leases and income to vacant properties. Next, we have industrial real estate. Those are obviously going to be the warehouses, the distribution centers, what we call flex industrial, which is like the small contractors that maybe need a little office and a little bit of storage or warehouse space, right? The flex term is where that falls into. And these can be low to moderate management. And depending on the leases, right, it all comes down to the leases. This is the beauty of commercial real estate, is the operational intensity oftentimes can be dictated and determined by what your leases say. So that is one of the beautiful things that I love about commercial real estate, is if you understand leasing and how to structure these leases properly, you can maximize your cash flow and value and minimize the management intensity. However, you're going to see this fall in the 6 to 8% cash on cash range. And again, guys, I always like to aim way higher when I'm going for deals. However, I like to be very conservative when I'm modeling, when I'm aiming for things, because I want to be very reasonable and realistic about what I think I might get out of this. And if I do better than that, great. I outperformed what I thought was going to be the average return for this deal anyways. And this is going to be, good for passive or semi-passive investors. A lot of people love industrial right now. And obviously with where e-commerce is at, the internet, and the evolution of consumerism, industrial is not going to be going away anytime soon. We've got multifamily apartments. Now, this varies, and we go into a lot more detail between what a Class A, Class B, Class C apartment means and what that entails. And you also have mid-rise apartments. You've gotten garden-style apartments. There's a lot of subcategories underneath multifamily. But for people who have single-family backgrounds or investment portfolios, and maybe you're in duplexes or triplexes or fourplexes, but you're looking to scale and get more bang for your buck, that's where people naturally transition into multifamily. But again, it's a lot more management intensive. You still have a lot of bodies underneath one ecosystem or roof in your properties, and therefore that requires good systems, good management. And again, you can do a third-party manager and make that somewhat passive. But depending on how big the property is and how much property managers are going to charge to make it passive for you, that may or may not make sense based on what kind of investment returns you're looking for. So again, understanding the management intensity, generally in the 6 to 12% cash on cash return space. And of course, I believe that multifamily is great for people who are hands-on, who have the time and energy to be the operator or want to drive more value by creating, more income through renovations at a property, generating higher rents, driving more income, which of course is going to drive higher value. This requires an active, a seasoned, and ultimately a hungry operator that's willing to get in there and do that work, unless you got a third-party manager that's going to be willing to do that work for you. Now, office buildings, of course, we all know, post-COVID era, not the hottest asset class for obvious reasons. But again, it is always got a time and a place. And depending on the numbers, I always tell people I love every deal, depending on what the numbers look like. We can mitigate our risks. If we can buy right, you make your money on the buy, you actualize it over time based on how you operate. That being said, office buildings, you can have anything from single tenant, individuals who are going to take up your whole office building. You might have multi-tenant, office buildings where you got tenants on each level, right? There's a lot of different ways. I personally like and own medical office buildings where I've got a couple different tenants in, dermatology. We've got a hospital outpatient center. We've got a pharmacy in one. We've got advanced therapy and physical therapy practices. So medical office, in my opinion, isn't going anywhere, but again, has some nuances to it, but can be a great investment strategy if you are looking to get into the office space. Now, I would say most of my medical office buildings are actually pretty passive. That being said, depending on how many tenants you have in there and what the leases say, it could be moderate to high management intensity. 7 to 10% cash on cash returns. Again, that could be much higher depending on how good of a deal you negotiate, or where you end up with your income on the deal once you go through the optimization plan. But these are good, rules of thumb for stabilized office assets, and generally is going to be good for experienced operators, maybe creative repositioners who are going, hey, this office building used to be this. What if we turned it into this? And you could make that financial sense. Okay, great. But office buildings right now are definitely lower on the totem pole when it comes to commercial real estate investors. Now, this is a space that I've played in, owning and operating multiple hotels over the years. Boutique hotels is one. Obviously, a lot of people coming from the STR space are going, man, how can I get more scale beyond just one Airbnb or 3 Airbnbs, right? Well, you buy a hotel that has 20 or 30 or 50 or 100 rooms, right? So boutique hotels have really become more popular over the years. It's a good way to get outside of the Airbnb and permitting legislation that hangs a lot of people up or restricts a lot of people from making investments in commercial hotels. You don't have to worry about those types of restrictions. You got motels, you got extended stays, you got flagged hotels, right? The name brand type of hotels that already have operating teams and systems in place. So a lot of different variation when it comes to boutique hospitality, but something that you can think about. But this is what I say to most that are thinking about hotels and hospitality assets. It is a very high management intensive business. It's not just a passive income asset. This is a living, breathing asset that has people in it, staff in it, 24/7, 365. So understand that you're not just buying a passive income stream, you are buying an active operating business and asset. Something to keep in mind, but it can be really fun. My kids don't get excited when I take them to my shopping center, and they don't want to tour the liquor store, but they love going to my hotels. And it's been a way that not only has hit return goals for me, but it's allowed me to create memories and experiences with my kids, which to me, there's an ROI on that, and it does factor into my investment decisions. Maybe it does for you, maybe it doesn't, but something to think about. And these can be a lot higher cash on cash returns depending on what kind of asset you buy, what kind of operating model you are employing in that. But this is what I say best for active operators and people who are really looking to build a brand, a business, a reputation in the hospitality space. Now, self-storage and mobile home parks, again, another kind of variation of an asset class that a lot of people love, that has done relatively well over the last few years. And this can be very low to moderate management. This can generate still very good quality, strong returns, hence why a lot of dollars have gone towards that space over the last few years, and it's gotten extremely competitive. However, cash flow investors and semi-passive operators really love this model. And whether it's you owning and buying the asset yourself, or it's maybe investing in somebody else's deal, a lot of benefits in all commercial real estate assets if you find the right deal, if you find the right operator. So just again, to recap kind of some of the management intensity that goes along with some of these assets. If you want something really passive, really hands-off, mailbox money, just send me a check and maybe I have to answer a couple emails or calls a quarter or a year. You're thinking about triple net retail. You're thinking about triple net industrial. You're thinking about triple net office. Again, we dive into a lot more of what triple net means on this channel, but this is going to be the passive column. Now, semi-active, right? And there's variations to this, some on the high side, some on the low side. You got shopping centers, industrial flex warehouses, Class A multifamily. You can make these relatively passive, but understand that there's still some active requirements and needs to protect the asset, to protect the income, and to protect the value that you are trying to get when investing in commercial real estate. And then, of course, you've got the active management, which is your, value add, kind of the beat down, run down multifamily assets that need a lot of attention, a lot of, management and oversight. You got hotels, RV parks, really anything in hospitality is going to be high management intensive. And of course, land development, being that this is something that requires your energy and attention 24/7 to keep the ball rolling forward on your development opportunity. So just some things to think about there. And then of course, cash on cash returns. Things that are going to have a little bit less yield tied to them, but again, more stability and less management are going to be your Class A multifamily. It's going to be the single tenant, triple net type of stuff, right? The things that are really going to generate higher yields, you're going to have to put that sweat equity in. That's going to require more time and energy and management and oversight. But again, you're going to get rewarded for that with hopefully higher yields. So that's going to be things that fall under that management intensive category, anything that's value add, right? Anything that we call opportunistic, that you can go and capture the opportunities, but it requires you to execute on a game plan, execute on a strategy. Those should generate much higher yields for you to want to go and take that risk and invest all that time, energy. However, you need to make sure that you are taking into account what these plans require. Whereas if you want something stable, a little bit more steady, a little more seamless, a little easier, a lot easier in a lot of ways, but maybe less of a return, these are some great options to think about. Now, the last thing, talking about your investor identity. So we talked about what aligns with your management intensivity that you are thinking about in terms of how much you want to put into the deal. You're looking at your cash on cash returns. What do I want to get from a return on the dollars that I invest into this deal? And then, of course, thinking about the alignment that these things have with your investor identity profile, right? So are you a passive cash flow investor that's just looking to be hands off? Are you an active operator that's willing to be in the trenches, eat, sleeping, and breathing commercial real estate all day, every day? Are you somebody that's just semi-active and you can, you got a W-2 job, but you got some free time to, invest and grow your hobby or your portfolio over time, and maybe you just want to be semi-active? Or maybe you are somebody that's like, I'm building a full-fledged business out of this. This is going to be my business for the next 30, 40 years, and I'm going to be an operator, a developer. I am active in this space. You can think about some of these types of assets that fall into these different categories. So thinking about how you want to finalize your choice, all I would say is just remember that this is not set in stone, right? Just because you decide to go in on one asset class to start doesn't mean you have to stay there forever. I know a lot of people that will say go an inch, wide and a mile deep. And I can also say that I have a lot of investor friends and buddies, and I have somewhat of a model as well where we own multiple asset classes and have a little bit of diversification, expertise in, a handful of different asset types, and we invest and operate in a handful of different asset types. So know that there's a lot of different ways to be successful in commercial real estate. And I want you to think about all of the things that go into getting you those wins right out of the gate, because that's most important, right? So making sure that you're matching your investment with your time, energy, and your financial goals. A great way to start with that first one being in congruency with what you're really trying to achieve, because that first one is such a big deal. Now, understand the management demands before you buy. Don't chase what's hot, right? Chase what really fits what you're looking to do. I know it's easy to get sucked up into the hype and this is working for them. But again, remember, all investors and all strategies are not created equal. And if you just mastered one asset class first before you decided to diversify into many, that would be my suggestion. That'll be a great way for you to get some confidence, get some reps, and ultimately build the momentum that you need, pour a strong foundation that you can build off of going forward. So if you're still not sure, don't forget to take the free investor quiz that we have, which is down in the show description below. And if you want to take my free CRE beginners crash course, just text the word free to 844-447-1555, or you can grab that down in the show notes below as well. But that being said, I appreciate you taking the time to really understand and identify some of the blind spots, because that's how you're going to overcome a lot of the fears that we have talked about in some of the previous videos, is just being enlightened about what you don't know. And as you start to connect the dots and become aware of what you don't know, you can then start to really lean in and sharpen your axe in the areas that align with your goals, your cash flow, and of course, your investor profile. Now, I'm just curious, which asset class resonates with you the most? Feel free to drop those down in the comments below, any questions that you might have. And until next video, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.